Hi, everyone. Welcome to the Origin IncomePlus Fund webinar. I'm Michael Episcope, principal and co-founder of Origin. And today I will be covering all of the current and pending deals in the IncomePlus Fund. The webinar should take around 50 minutes. There's a lot of material to cover, and I will try to be as brief as I can in every section, but also give you enough detail to paint a picture about how we operate as a company and then why we like the underlying deals and what the thesis and business plan behind them. The purpose of the webinar is to provide our current investors with a live update on the portfolio and also provide new and prospective investors with information about the fund, the structure, the current assets, the pipeline. And that's really so you can decide whether or not this is a fit for you and your portfolio, and most of all, how you can participate. Now, I will also be talking about a sidecar opportunity that just came about. We'll be marketing this next week. There is a deal in our pipeline that I'll be talking about. It's actually the fifth deal today. And that deal was a little bit too large for the fund in terms of the amount of equity we wanted the fund exposed to. So what we've done is carved out a piece of that equity so that individual investors can invest directly into that deal, and it comes with favorable terms as well. Now, the first thing I want to talk about is this is actually a really great time to be investing in the IncomePlus Fund. There's two things happening right now. And the first is that there is no waiting list in the fund. And our most recent deal will exhaust the current queue of investors, which means anyone who commits to the fund today will be able to invest 100% of their capital immediately and be diversified across all four of the fund deals and soon to be 6 deals. Now, last year, there was roughly a 6-month waiting period between the time someone committed and when we were able to invest the capital. But the deals team's activities have really paid off, and we're now closing 3 deals over the next couple of months. The second reason this is a good time is that we are 2 months away from floating the share price. And new investors can get in at the fixed share price of $10 until March 31st. And after that, the share price will float based on the net asset value of the underlying assets. Now, we do expect there to be a slight increase in the share price at that time, so it's a great time to be committing to the fund. If for any reason during this webinar you need to drop off, there is a whole host of other information that can be accessed via our website through our portal. And I encourage you to go there. You will find this webinar, you will find the PPM and other information there that will be really useful in helping you make your decision. And you can also call your contact who's available through the portal. You'll find them under the contact section. You can email them, schedule a call, and find out more if you want to have a conversation. And you can always email investorrelations@origininvestments.com. I'm going to start by giving you a little bit of an overview of the company, and then I'll delve into the fund. And at a high level, what Origin does is we help individuals build wealth through public and private real estate offerings. The company was founded in 2007 by my partner David and I for the sole purpose of serving the needs of the high net worth investor. And in the beginning, we were the client, and this is really how the entire thesis, investment thesis of Origin came to be, because our original vision was to take the best of the institutional investing world and bring it to individuals like us. We wanted access to high quality opportunities. We wanted fair fees. We wanted great service. We wanted to have a high quality team behind us. And that's really what we've built. And it's important to note that we are a direct-to-consumer model. We do happen to go through RAAs who have us on their platform, but really we're not a middleman. And that's the difference, that we have a direct relationship with our individual investment partners. And that's important to us, that people know us, that we know you, and that you have all the information you need to make a decision here with respect to joining Origin as an investment partner and investing in one of our funds. To date, we've acquired more than $2 billion in real estate, and that's really over the last 10 years. And we have been named one of the most consistent top performing managers by Preqin, which is a third-party service that rates fund managers. And that's for the returns we've been able to generate in our previous funds across funds 1 and 2, and now fund 3 has just finally been fully invested as well. We've done more than 50 deals in the last 10 years, have no losses in any of our funds, either realized or unrealized. And today we operate 2 funds, the IncomePlus Fund and the QOZ Fund. And our team is made up of approximately 30 team members. That's growing dramatically. We're actually in the process of hiring about 4 or 5 more to that team. So by the end of Q2, we're going to have a team of right around 35, 36 people. But this team really helps us execute the strategy and serve the needs of our investors, from everything from finding deals to managing deals to producing the reports to handling the accounting, the legal, and every department in here works really hard to live and create the Origin vision so that your experience is exceptional as an investor here. We focus on 11 fast-growing markets across the U.S., and we have 4 regional offices that serve as hubs for sourcing. And today we serve more than 1,000 investment partners. And I mention that because we've grown tremendously and we've scaled, and my partner and I have invested heavily across all our funds, and it's that notion of alignment and why we built the fund and the firm that's really helped to attract this many investment partners. And it's really been in the last year that we've grown from 500 to 1,000, and that number continues to increase each and every day. But my partner and I are investing $10 million into this fund. We're actually we're making the investments over time, but that will be our minimum investment. And we've invested more than $54 million of personal capital across all of our funds since the inception. And ultimately what we try to do is create products that we would invest in and that will maximize wealth for our investment partners. And we do this all in real estate, obviously. But I think one thing unique about us is that we didn't build the firm with the idea that we would get rich through operating companies and fees. We came from a different industry and we had money when we came here. We came to the table with the idea that we were going to build a firm that focused on investment returns. And I think that's a big difference between people who come to Origin and why we were built and how we're built and the whole purpose of why we exist. Now, I'll move into our history and then which will lead us up to kind of how the IncomePlus Fund came to be, how it's different than what we've done in the past, and certainly how it's different than other funds in the market as well. Excuse me. Historically, we operated closed-end funds. And a closed-end fund means that you go out and you raise a limited amount of capital or a finite amount of capital, and then you take a couple of years, maybe 2-3 years, to deploy that capital and you build a portfolio. And that was how we operated Funds 1, Fund 2, Fund 3. And those funds tend to be buy, fix, sell. You buy an asset, you fix it up, you hold it for a year or two, and then you sell it. In an open-ended fund, the strategy is a little bit different. It's buy, fix, and hold. And the easiest reason to convey why we did this is because real wealth is created by buying and holding quality assets forever, not fixing them, flipping out of them, and making a nice IRR and a little bit of money. That's what we learned, and as we look back and we said, we're a firm of continuous improvement, and when we look back at Funds 1 and 2 and even looking at 3, we really wish we had held all of those assets. Everybody in the fund, including my partner and I, would have been a lot wealthier rather than selling those and then letting the money sit idle as it was redeployed into new opportunities. So This fund follows the very same strategy as Fund 3, 2, and 1 did, in the sense that we're buying core plus and value add assets. But the difference is rather than selling them, we're holding them much longer and then just managing them to minimize the impact of taxes. I think that if you're a skeptic, you probably understand, or maybe even not, if you're just thinking about this, there's always the risk of recession and there's a risk of holding assets, and that's very true, and asset prices do go down. But when you look back at the recession of 2007, and you think, well, if I had put together a portfolio in 2006 and 7, how would that be performing today? And in real estate, especially in multifamily, when you look back at that period, you need to be able to withstand those recessions, and that comes with risk mitigation practices, etc. But I can only tell you that had you bought real estate in 07 and you held it to today, you'd be very happy, and those prices are not replicable in any way, shape, or form in today's market. The market has moved considerably, and you can say that about the stock market and other assets as well. And the strategy just needs to be continue to allocate into asset classes that have a history of moving up over the long run. And that's what real estate is to us as well. So let me jump into the Income Plus Fund and really why we created it and how it's different. The strategy of the Income Plus Fund is to deliver 9 to 11% total return to investors. And within that 9 to 11%, 6% of that is to be delivered via yield, consistent income. And the yield is really key here. Roughly 60 to 70% of the target return is coming through cash flow. And yield in real estate is much less volatile than price appreciation. It's simply easier to predict. This isn't a fund that is likely to produce 25% gains, but it's also not a fund that is likely to produce 25% losses either. We've structured it in a way so that the volatility around that 9 to 11% will be minimal. We're not taking outsized risk in this fund. We're not using financial engineering to produce return. It was really designed for the moderate risk investor who wants exposure to real estate with minimal volatility. Now, there are 3 key elements that differentiate this fund. And the first, and I'm going to combine these, is really strategy and structure together. The fund is made up of 75% direct equity, which means these are properties that we are going to be in the ownership position, that we are going to be the manager, we are going to be buying and owning these directly. The other 25% of the fund will be made up of preferred equity positions. And there's obviously a trade-off, risk, return, tax benefits, etc., for each of those positions. But when you combine them together, the end effect is that you still have participation in the real estate market. You have consistency and stability in yield through the preferred equity side, and it creates a very tax efficient structure as well. And the preferred equity it sits in a safer place in the capital structure, so it reduces volatility by creating more returns across the entire portfolio. And in today's market, what we're seeing is that the yield we are able to create on the preferred equity structures is sometimes in excess of what is achievable on the equity side. So we can actually be in a better place from both a return and a safety standpoint. The second thing, and I sort of mentioned this, is the tax efficiency of this fund. And this is something that we really have moved into. And the difference between buy, fix, sell and buy, fix, hold is that in a buy, fix, sell model, once you sell, that money sits idle, you pay taxes, etc. In a buy, fix, hold, you're putting your money to work over time and you're letting it all grow together, and you're minimizing the impact of taxes until the time you sell. And what that allows you to do is actually take less risk over a longer time period and make more wealth. Because in this fund, unlike a called capital closed-end fund, investors are putting 100% of their money at work in the fund at one time, and that money will continue to grow as well. But it's really the combination of debt and equity together, because traditionally debt is going to be a tax inefficient investment, but when we're pairing that in a fund structure with direct equity ownership and properties that produce depreciation, the properties that we own actually produce excess depreciation, and that excess depreciation is used to offset the ordinary income tax of the preferred equity. So in essence, what we're able to do is create a 6% annualized yield on the fund that we can deliver on a nearly tax-free basis. The last thing is, when it comes to tax efficiency, it's not to say that we won't sell assets, but now when we sell assets, we actually have the ability within the fund to use a 1031 exchange mechanism to defer those taxes indefinitely. So under a 1031 structure, when you sell a property and you buy another property, there are no taxes owed on either profits or any of the capital that comes out of one property into another. And the last thing I'll say about the fund that makes it unique is that this is a very well diversified fund. Investors will be their capital will be spread across every deal in the fund, across all of our markets, and we invest primarily in 11 high growth markets, all the markets that you're aware of in Nashville and Denver and Phoenix and Orlando and Atlanta and Austin, Texas, and places like that. And as the fund fills up, you will see more and more exposure to each one of these assets. Today, right now, we have 4 assets in the fund and we have 1 under contract, but we are continuing to find new assets, and our pipeline is pretty robust in these other markets as well. So I talked about diversification across geography, but it's also important to note that investors will be diversified across deals as well. And what I mean by that is that our fund, every single asset in the fund, is in its own special purpose entity. And something we do here very well is risk management and making sure that if things go wrong, that our risk is limited and it's mitigated. And one of the ways you do that in a fund is you don't cross-collateralize debt, you don't cross-collateralize assets. And when they're in a special purpose entity, if something goes horribly wrong, the loss is limited to that entity and it doesn't taint the rest of the fund. So when you're investing in the fund, you can think about it as not a single investment in the fund, but a series of investments across each and every property that we own that you will be an owner in. So those are a few of the differentiating factors behind the fund. And now I'll talk a little bit about the overview of how the fund is shaping up. We're about a year in today, and then I'm going to go into the individual deals in the fund. The fund currently has around $47 million invested across 4 opportunities. 2 of those opportunities are in preferred equity investments and 2 are in direct equity investment. And what that means is that about 55% of the fund's equity is currently invested in preferred equity, but that ratio is going to change in the next couple of months as we have another deal under contract right now that's expected to close in early March. And I'll talk about that deal at the end of all of the deal pipeline here. What I mentioned before is that the target ratio of the fund is 75% equity and 25% preferred equity. But in the early days of any fund, you're always going to be out of sync because by very definition, the first asset that you acquire is going to be 100% of the fund's equity. So you will see this ratio come into line as we acquire more and more deals for the fund. The last thing I'll say before I get into the deals is that, overarching themes about what we look for in properties, etc. And all of the IncomePlus Fund's properties are located in higher end submarkets in our target markets. We cater to what we call a renter by choice demographic. And we do that because these are individuals who could buy but choose to rent. They have college degrees and in many cases postgraduate degrees as well, and they hold white collar jobs. they are generally less impacted by recession. They are less likely to get laid off. They have more disposable income, so can afford rent increases more easily. And they really care about their credit scores, so they're not going to skip out in the middle of the night as well. And the renter profile that we look for is consistent across our entire portfolio. We're essentially looking at Class B plus and above. We're not dealing with workforce housing on that end. We're not dealing with C. That's a completely different strategy. And I just want to make that apparent because any multifamily operator and any investment manager has a thesis or a segment of the market they focus on, and that's where our focus is today. We've done Class B, we've done Class C, but for the purpose of this fund, we believe that this segment of the market will produce the best risk-adjusted returns with the least amount of volatility. Now I'm going to go over each deal and discuss the investment thesis, what we liked about it, a little bit about the business plan, and the return potential to the fund, and just provide a little bit more color on the acquisition side. Aspire Westminster is an $18 million preferred equity position in the fund. And this is a ground up multifamily project that, when it's completed, will consist of 226 units and 38,000 square feet of ground floor retail. The total project cost on this deal is $87 million. It will take about 2 years to complete. And our position, our $18 million, occupies the space in the capital stack between 52% and 75%. So there's a senior lender that occupies from 0 to 52%. We are from 52 to 75%. And then there is 25% equity above us that's subordinated to our position. The yield on this investment is 13%, with most of that accruing until the property is refinanced, but we do get some form of that in current pay as well. Now, this was a deal we originally sourced as a direct equity investment, and we were working with the sponsor on terms, and we couldn't come to an agreement. But what we also found during that process was that they were really undercapitalized, and they weren't optimizing the capital structure. So what we did is we turned the tables, and instead of offering them equity for the project, we said, how about preferred equity? And so our position ultimately is structured as a preferred equity position here. And I do want to emphasize that we are originating preferred equity positions on deals we want to own. We don't view these in the same way a banker would, where the property is our collateral. We believe in the merits of the deal, and strongly believe the sponsor will be able to achieve their business plan and build value. This isn't a loan-to-own strategy, but it's just the way we view the world and look at deals themselves. Generally, we want to be in the equity position, but we can't. And that's really how many of these deals come to be, is that we are having a conversation with a sponsor about equity, and ultimately we're able to structure it in a different way. And that's one of the advantages of running multiple funds and also having flexibility of capital. A little bit more about the property, but the property is located in downtown Westminster, and downtown Westminster is an area that's northwest of Denver on Route 36, and it really sits between Denver and Boulder. And anybody who's been to Denver knows how rapidly it's expanding. It has tremendous population growth. There is a lot of construction, a lot of people moving in, and that market just continues to grow and outperform. And I think the one thing that we really liked about this location was just its proximity between downtown Denver and Boulder, and we're in this transportation corridor that is just starting to boom. And you can see downtown there's this halo effect into other areas, and so that was Denver is an area we've covered it for a long time, and this is part of a master plan
development that is a mall that's been taken over by the city, and it's being redeveloped into a mixed-use property. So when we think about dead malls and what the possibilities are there, this is a great example of how the city of Westminster sort of has taken it upon themselves to create a master plan community, and this is one of the developments in that community, which is it's a fantastic project. The developer here on the project is Sherman Associates. They've been in the market for 40 years. They're highly experienced. They've developed over 6,000 multifamily units and 600,000 square feet of commercial space. We actually broke ground on this project in March of 2019, so roughly about a year ago. And the scheduled completion date is around February of 2021. So today the construction is on track. We are out of the ground. We have elevator shafts going up, and we've poured the concrete foundations and basements. And we're currently in progress on further structural concrete improvements, building the parking deck, etc. But the project, most notably, is on track and on schedule. Anatole at Westinghouse is the next deal I'll talk about in the fund, and this is a property with a total capitalization of $35 million, and the fund has committed $12 million in equity to this project. We've actually invested $12 million in equity. So this is direct ownership, and Anatole is a 250 unit multifamily asset built in 2015, so fairly new, and it's located in the southern portion of Georgetown, Texas. And Georgetown, Texas is located about 25 minutes north of the Austin Central Business District. And the loan here on this property, and generally all of our direct ownership properties, are going to be leveraged at about a 2-to-1 ratio. This property happens to be about a 64% debt to equity ratio, so quite a healthy amount of equity that we're putting into this property. Now, how this investment came to be is that we acquired it off market with a relationship that we've had with a sponsor for about the last 7 years. And the market today is really flush with capital. So our goal is to find a lot of opportunities off market. It's not to say that we don't compete on market. It's just that what we've seen is the market is moving so quickly and it's flush with capital that we tend not to have a high hit ratio on competitively marketed deals. So much of our time is spent looking at deals off market and trying to find fair prices where we can transact. So you'll hear the off market theme throughout today's presentation and in future ones as well. Now, again, this thesis starts with location and putting ourselves in front of demand, and this was a unique opportunity to really acquire a newer asset below replacement costs in an area that directly benefits from the growth of Austin. The property itself sits off of Westinghouse Road, which is an east-west artery that connects 35 and Toll Road 130. Now, Georgetown is definitely the more affordable alternative to Austin, and we've seen this sort of what we call a halo effect happen in so many other cities where you have a city that's growing so quickly that then the surrounding areas benefit as a result, because the affordability in the central business district and the immediate area becomes so expensive that people are then forced to drive 20, 25, 30 minutes, and in some cases maybe even an hour depending on the city. And that's what's happening here, and that's one of the theses we like about this particular project, is its proximity to one of the fastest growing cities in the United States and its affordability component. Now, Anatole was built in 2015. It's only 4 years old, and the quality is comparable to today's new construction. So we're spending actually very little capital on this, and the story here is that we bought it off market at a fantastic price, and we were able to meet our cost of capital just through basis alone and acquiring it through a limited marketing process. And there's some enhancements we can do with management as well to increase rents, but it's really about buying right. in this deal. And to explain this deal, I guess, a little bit further and how we view risk, but we're looking at really a core deal that produces a core plus return. And that's how we define alpha, is when you're taking lower than market risk to produce market like returns or above market returns. And so this deal is, as underwritten, expected to produce a 40% total return to the fund over the first 3 years of ownership. So we're excited about that deal, and that is the second deal I'm going to talk about in the Income Plus Fund. And now I will move to Star Metals. Star Metals is a preferred equity position. This is a $6.6 million investment by the fund into a Class A 9-story mid-rise apartment building located in Atlanta in the West Midtown submarket. And anybody who lives in Atlanta, who knows Atlanta, understands that the West Midtown submarket is one of the hottest areas in this city. So like the previous deal that I talked about, the preferred equity deal, this deal came about in much the same way, that we were speaking with the sponsor about a direct equity investment into the project, but we couldn't come to terms. They didn't need it, so we ended up right-sizing and optimizing their capital structure through a preferred equity investment. And we're a small piece of the entire project, but where we sit is in a very favorable position, especially when you look at it relative to the yield that we're generating. The total deal size is $131 million, and our preferred equity position sits between 68 and 74% of the capital structure, and we were able to negotiate a 15% yield on our equity here. And I alluded to this before, but in today's market, when you're getting paid 15% in a preferred equity position, and you have this much protection, the equity isn't actually making a lot more than you are, but they're taking quite a bit more risk in something like this. So for these particular projects, we feel really good about the position we're in. And again, this is a project that we believe in and think that the cost is $131 million, but they're going to create a tremendous amount of value here as well. Now, this, I've already talked about the location here a little bit, and I'll just fill in maybe some of the holes slightly, but what we liked about this is walkable urban housing. And it is immediately adjacent to upscale restaurants, bars, and for many it's a short walk to work. And this is an area, a submarket, where more than 17,000 new jobs have been announced since 2015, which means quite a lot of demand for new housing in the area. And what we further liked about this particular project is the unit size, is that they're building smaller units than market average, and they're not quite micro units, but what that does is, especially as construction prices go up, is it keeps the affordability factor a lot lower. So the chunk price of your units is still affordable, and the way they make up for that in a lot of these new developments is by putting in superior building amenities, fitness pools, I should say fitness rooms, pools, dog amenities, etc., so that people really have value in the project. Even though their units might be smaller, they're okay with paying it because of all the value that the rest of the building provides them. This overall, this project will be 409 units, 16,000 of retail, and as it stands today, the project itself is on track. We are on budget. Here, it is early. This broke ground in July of 2018, so we're a year and a half into it. And this is scheduled to be completed by 2021. So we will keep you posted on this, but as we sit here today, we are on track in this particular investment.
Portofino is our most recent acquisition. This is the direct acquisition of a boutique Class A 121 unit multifamily property, and it's located in Orlando, Florida. The total deal size is $27 million, of which the fund has provided $10.2 million of equity to secure a direct ownership position in this property. And that $10.2 million of equity on a $27 million property is very typical of our debt to equity ratio. We usually use roughly about 60 to 65% of debt to capitalize all of our properties. This particular property was built in 2018 and is located in the southwest submarket of Orlando known as Champions Gate. And this is a relatively newer and upcoming submarket, and it's part of the ongoing connection between Orlando and Tampa. And that's a corridor that continues to fill in because of the rapid growth of both of those cities. Now, while most people associate Orlando with theme parks, it has really changed in the last 20, 25 years, and it's truly an employment mecca today. And it consistently ranks in the top 10 growth markets for population and job growth. And certainly a lot of that is helped by the theme parks. They get more than 68 million visitors per year, which helps in the hospitality industry and all the ancillary industries that touch them. But in addition to that, you also have a very vibrant healthcare, education, defense, and construction industry. And so you've got all of the healthy pieces of a diversified economy that go well beyond the gates of Disney World. Now, one of the things we love about Orlando, because we cover 11 markets throughout the United States, is really the affordability. And of all the cities we cover, Orlando is one of, if not the most affordable market, because we're in Denver and we're in Charlotte and we're in Raleigh and Atlanta and other places. But the affordability of Orlando is also one of the reasons why it's growing so much. And that will undoubtedly continue to drive population growth down there. The first thing we liked about the property was the basis itself. And we acquired this property for $222,000 per unit, or around $211 per square foot. And that price is really at or below the immediate comp set, but the quality of our property is far superior. And that's kind of a thesis we always want to look for, right? We want to have the best property at the market at the same price, or if we're looking for the affordable price property, then we want to have it at an extremely low basis so that we can attract that affordable renter profile. And this one happens to be in the camp that it's a Class A property, the best property that we've acquired sort of at the basis of the other properties in the market, but our amenity set and the quality of the property is much, much better. Now, one thing that was really interesting about this property and helped us acquire it at a better basis was the debt. And the debt here was in place. It had to be assumed, and it has 38 and a half years remaining. And the cost to what we call defease it, which is to retire the debt, would cost millions of dollars today. So that alone kept a lot of potential buyers away from this sale process because they couldn't refinance the debt. They couldn't leverage the property up higher than what it already was. Now, I don't even want to calculate the date or how old I'll be when this loan matures. But what it does for us is it completely mitigates the interest rate risk and the refinancing risk to this property. I should note we're paying a slightly higher interest rate on the debt, around 4.2%. But this was also one of the reasons we were able to buy the property at a better basis. Our cost of capital is fixed, and if we have fixed debt at a higher rate, then the only thing that can change is really the price of the property. And that's what we were able to do. And we make that trade-off all day long to get a better basis, even if we have to buy it at slightly above market debt in place. Now, the other thing is that this debt is only about 61%. I alluded to this before, 61% loan to cost. And most buyers in the market are looking to put 70 to 75% debt on this property. But again, we are not a highly leveraged model. So having 61% debt on this property is actually very consistent with our entire business model. So it gave us an advantage in the marketing process here. The other reason we like the property, I talked about affordability at the Orlando level, but what's more important is affordability at the property level. And this property has a history of attracting a very high-end demographic renter. The renter here, the median income of our renter is $85,000. In the immediate area, the median income is $66,000. So what we look at is an affordability ratio within the property itself. And because the rents here are about $1,800 a month, when you take $1,800 and you multiply that out by 12 and then you divide that by 85,000, you get an affordability ratio of around 25%. And the reason why that's important is because it gives us an indication of how likely it is that we can effectively raise rents for the current tenant. And when you start to get into an affordability ratio at 30 to 35% of income, meaning 35% of a person's income is going towards rent, you lose the ability to continue to push rent, because then it becomes a choice of paying rent or giving something else up. So what we like about the current makeup of this is these individuals have quite a bit of extra income to be able to afford more rent here. The property, as underwritten, is expected to generate a 40% total return to the fund over the first 3 years of ownership. And that's how we look at all of these opportunities, is making sure that it meets our cost of capital during the first 3 years of ownership at a time period that we can, with a lot of confidence, be able to predict. And so 1.4 multiple is sort of our minimum return, and that's a 13% IRR that then ultimately, after fund fees are applied, then you get down to that 10 to 11% net IRR. Now, the last deal I'll talk about today is a property that we have under contract and is scheduled to close in early March.
And this deal is called Monroe and Aberdeen Place. And this is a direct acquisition of a 120 unit Class A boutique multifamily property that was built in 2018. The property is located in the West Loop neighborhood of Chicago, and the total acquisition price of this property is $66 million, of which we will be putting 40% of equity into the property in total. So you have this is actually our lowest lever deal at 60%, and we'll be putting a total of $27 million into the property. But I need to note, because the fund is only going to be contributing to this property around $17 million. And the reason why is because this property would give us just too much exposure in a single asset. So what we're going to be doing next week is we're going to announce a sidecar for this opportunity for current fund investors, those who are committed to the fund and those who are in our other funds. And we're bringing out a sidecar of $7 to $10 million that will be have very favorable terms to our current investors, and better terms than what the fund actually has. So the minimum of that sidecar will be $50,000, and if you want more information on that, you can email investorrelations@origininvestments.com. Make sure that you're on the mailing list, and that will go out next week. Now, typically, we haven't been as active in Chicago as we used to be, and that's really because of the fiscal uncertainty. So I think when a lot of people see this deal and they see it in Chicago, they might think, especially if you live here, there's a lot of uncertainty happening, and really, that uncertainty is leading to less and less transactions, because the bid ask between the seller and the buyer is so large that there's just a lot of properties that aren't transacting. And the biggest reason is because of the unknown in taxes. And I'll talk a little bit about how we solved for that and how we got comfortable with that. But once again, this opportunity was brought to us by a broker, a personal relationship here in Chicago. And we were one of only 3 groups invited to the table to actually bid on this property. And we ultimately were able to negotiate a price that worked for us and the seller just didn't want to go through a full-blown marketing plan here. But we were fortunate enough to be invited to the table and be awarded the deal. So again, when it comes to the taxes, it's a huge uncertainty, because of what's going on in the city. And the only thing we can be certain of in Chicago today is that taxes are going to go up, and they're going to go up substantially. And we consulted two tax attorneys to get an estimate of future taxes and put those into our numbers. And we ultimately negotiated the price based on a more conservative estimate of the taxes and where we think they'll be in the property in 2 to 3 years from now. Now, just to put this in perspective, the current owner is paying around $4,000 in taxes per unit on an annual basis. That's about $480,000. And we are assuming an 85% increase in taxes over the first 3 years. So actually 90%, because we're assuming a tax rate of $7,650 per unit by year 3 of ownership. So that's actually a 90% increase in taxes. And we feel this is conservative, and it's an area where we actually may be able to win if the actual taxes come in well below this estimate. And I think if I'm painting a range, if we're wrong, the taxes are at $8,000, and if we're right, the taxes are either where we are, and they could be as low as $6,000 per unit. So when we put this together, this was one of the big areas of concern and concentration where we focused the most. So getting those tax attorneys and the opinions and wrapping our heads around this in our arms was really important. So that's how we overcame that risk. Now, from a physical standpoint, one of the most interesting things that jumped out to us about this property was how differentiated it was compared to what is being built in the immediate area. There is nothing commoditized about this property, and I give the developer a lot of credit because they really built a unique property for the area. And one of the things right away that we saw was that 97% of the units here are 2 and 3 bedroom units with an average size of over 1,100 square feet. And typically, you see the opposite in this city, and the trend today is going to smaller units and building studios and 1 bedrooms. And we've seen so many projects, and I think everything going up is an average unit size of $600 per square foot, and majority studios and 1 bedroom. So when we saw this, we kind of looked at the market and surveyed and realized that there was really this void in the market for a property that was catering to the 2 bedroom and 3 bedroom residents here. And the physical elements of this property are outstanding. These are true condo quality units inside when you go through, and you wouldn't know the difference between this building when you walked in being a rental and a high-end condo right across the street that is catering to homeowners over there. It has 10-foot ceilings, crown molding throughout, full depth stone countertops, full-size washer dryers, and there's a heated attached garage as well. In Chicago, that's a phenomenal luxury where a lot of these are surface parked, but it's a necessary as well, especially when we get these polar vortexes that fly through here. To be able to park your car in a heated garage is a very nice luxury. Now, lastly, what was interesting about this property, we had to get our arms around this a little bit, is this is a non-amenitized property, meaning that there is no real true fitness center here, or pool, or area that you would consider a place for people to congregate as well. And in a suburban location, those amenities are a must. Those are table stakes. You have to have those in the property. But with this property, the neighborhood is the amenity. And the West Loop is the hottest area in Chicago. And this is an urban property that sits right in the heart of the West Loop. It's a 10-minute walk to the Central Business District. Google's headquarters are a few blocks away. The Randolph Street restaurant scene, Soho House is 2 blocks away. So you are really right in the epicenter of where all of the action is happening here. And it hasn't hurt demand either. This is a property that's been occupied consistently between 95% and 100% since the day it was built. The other thing that's interesting from this unit makeup and the lack of amenities is that it flows down to the bottom line, because typically in a property, we are going to look at a 35 to 40% expense ratio, meaning that for every dollar in revenue the property produces, about 40 cents of that revenue is used to pay expenses. Well, in a property like this, the expense ratio is actually below 30%, and it's closer to 25%, because we're not attending to the fitness center or the pool, etc. And what happens, because you have closer to 25%, is that every dollar that the property produces, you're dropping 75 cents to the bottom line. So you can imagine, as we create more and more revenue on this property, whereas if we're adding $1 million in revenue, we're throwing $750,000 to the bottom line, where a typical property, if you're adding $1 million in revenue, you're only dropping about $600,000 to the bottom line. So that's a unique advantage of a non-amenitized property in an urban setting. So lastly, I do want to credit the developer. They did a great job of nailing this property, the makeup, where it sits, and using, and as we've gotten to know this property and the layout, we've been really, really impressed, and we're excited to take this over. And the business plan here is really quite simple. The developer did a great job of developing the property, operating it, managing it, etc. But he did leave some meat on the bone, as we call it. And the meat on the bone is simply to start charging on parking. And parking in the city, especially in the West Loop, can cost residents anywhere between $250 and $400 a month. And what we have in our underwriting criteria is that we're going to phase in parking over a 3-year period at a cost of $250. And we're making very modest increases in the actual rents themselves at the units. So the business plan is realistic, it's achievable. Our comp set is already doing this, so this isn't something that, if we do this, they can go somewhere else. There's actually inferior comps that are charging much higher rents than what we're charging here. So we feel great about the business plan here being achievable. And the other thing, from a macro environment, what's going on here in Chicago is that a new affordable law passed that requires new development have at least 20% of affordable units in their properties. And what that's going to do is it's really going to put the brakes on new construction, because when you have to set aside 20% of your units for new construction, that means the rents you have to get, set aside 20% of the units for affordable housing, the other 80% have to get much higher rents. So this property was delivered a couple of years ago. We're grandfathered in. There are no affordable units here, but the lack of supply in the pipeline for the next few years should bode well for anybody currently owning property in the city itself. And this deal, after we're all said and done and we've underwritten it, it's actually, from a return perspective, it will generate around a 45% gross return to the fund during the first 3 years of ownership, and that's on, pretty much a core profile deal with low leverage. So we're very excited to be adding this deal to the fund. The fund will put anywhere about $17 to $20 million, depending on how much money we decide to raise in the sidecar, and that will close in the end of March. So anybody in the queue right now, their capital will be called next week for this deal that will go into the fund. And then if you'd like to allocate even more to this deal, we have a sidecar on top of that, and those details will be available next week. So that concludes the deal section of the fund, and overall, we're really pleased with the way the fund is coming together. And the overwhelming theme is that we're acquiring properties like Monroe and Aberdeen that meet our cost of capital with below market risk. And many of our properties in the portfolio would be considered core or even core plus opportunities that are able to achieve core plus and value add returns. And that's kind of how we look at the world and how we define alpha and what our role is. Our role isn't to go out and assemble this fund with 10, 15, 20 marketed opportunities that we're just paying the highest price for. Our role is to buy right, and that's what we do very well. And you'll continue to hear the off-market theme in future updates as well. Now, if you'd like to invest in the fund, learn more about the fund, go to our website and log in if you already have a registration. And if you don't have an account, I encourage you to create one. This will be a way that we will communicate with you about the fund, about future investment updates, etc. But you can also go there and peruse our documents online on your own time, right? The PPM is in there, the fund deck is in there, everything about us is in there, our history, our track records, all the other materials that you will find useful to help make a decision. And once you become familiar with that, you can reach out to your personal Origin contact. And that contact and their information can be found in the portal under the contacts section itself. And they are intimately familiar with the fund and every deal and have extensive backgrounds in the finance and real estate industry. So they can take care of you and answer every questions, and also answer any questions about the investment process itself and walk you through that and get you through there. Now, if you have any questions relating to this webinar, we're not going to take any Q&A right now, but feel free to follow up and email us at investorrelations@origininvestments.com, and we will get back to you with those questions. We'll answer those and email you by next week. Okay? Thank you so much for listening. Really appreciate your time today. That's all we have. Thank you.